professor of mathematics at the University of Paris. His research interests include modeling, counterparty credit risk, XVA, risk machine learning techniques, and all the related mathematical topics in the fields of, for example, backward stochastic differential equations, random times modeling, enlarged Borel filtration, and numerical probability. He's the author of several research papers and 2 books on financial modeling and on counterparty risk and funding. He's associate editor of several journals of the area and a member of the Scientific Council of the French Financial Markets Authority. So we're going to start. So thanks a lot, Stéphane, for accepting our invitation. And we can start if you want.
Sure, with pleasure. Thank you very much. Can you hear and can you see?
Yes, I can see.
Okay, perfect. So welcome to this course about XVA analysis from the point of view of, let's say, theory today, and practice maybe next week. The XVA field, originates, of course, from counterparty credit risk. And on these plots, I'm showing on the left the corporate credit spreads in the last 20 years on the top panel, and with a zoom on the last year with the COVID crisis on the bottom panel. So we see these big spikes at the time of the global financial crisis. That was 2008, 2009, and then again at the time of the Euro sovereign crisis, and again very recently at the time of the financial COVID crisis. And on the right panels, you see analogous graphs, but focusing on banks. Okay, so we have corporates credit spread on the left, and we have bank credit spreads on the right. So one might say that on the left, we have the credit risk that matters when one thinks of CVA. Your clients may default, and that may be costly to banks. On the right, we have the own credit spread of banks, which triggers their FVA. So all these XVAs basically were, let's say, announced by the global financial crisis or the post-global financial crisis regulation, okay, with regulators asking to banks more, let's say, more collateral and more capital, and also clearing of at least standardized derivatives. Okay, where clearing means passing from a network of financial transactions, like in the top of the picture, where all actors are trading bilaterally between them, so including big banks in blue, smaller banks maybe in pink, and corporates in orange. Whereas when part of the trading becomes centrally cleared, then let's say that major banks or clearing members are let's say, clearing their edge, typically, through a CCP, which is becoming a buyer to every seller and a seller to every buyer. Okay? Which means, given the evolution of markets, it's important to be able to carry this XVA analysis not only in the case of bilateral trading, but also in the case of centrally cleared trading. So which means we'll start by let's say, an abstract framework for XVA analysis, and we'll see along the course how we can apply it both to bilateral trading and to centrally cleared portfolios, and in the end to any combination of both, so that we can address the realistic situation of a bank which is involved in both kind of networks. So this regulatory evolution toward more collateral and more capital was devised as if, in a sense, banks would be indifferent to the cost of collateral and the cost of capital. And the quantification by banks of, let's the way we see it, counterparty credit risk incompleteness on the basis of various XVA metrics emerge as the unintended consequence of the banking reform. So these XVAs are pricing add-ons or rebates, of course, depending on whether the bank is a buyer or seller in transaction. So add-ons or rebates with respect to the counterparty risk-free value of financial derivatives. And these add-ons are meant to account for counterparty risk and its capital and funding implications. So VA stands for valuation adjustment, and X is a catch-all letter to be replaced by C for credit, D for debt, F for funding, M for margin, the specific sense of initial margin, and K for capital. So we will browse all these VAs along the course. So the one interesting thing is that these XVAs denote add-ons at trade level. So when you are selling a derivative, the price would be mark to market plus or minus a certain funds transfer price, which is gathering all these XVAs, which are relevant for the bank. But the XVAs are also, in the first place, accounting entries at the aggregate portfolio level. And these entries are very significant in the result of banks, as it was recalled in the Santander talk a few minutes ago. And the funny thing is that it's not only the cost for bank of defaults of their client in the future, but once this is accounted for as a CVA liability to the bank, it's also the risk for a bank of its CVA increasing, right? So CVA is a liability, and if the CVA of the bank deteriorates, that's a loss for the bank. To the point that it was said in June 2011 Basel Committee report that during the global financial crisis, even 2/3 of the losses attributed to counterparty credit risk were in fact of this kind, that is due to CVA losses, whereas only about 1/3 was due to actual defaults. In January 2014, JP Morgan recorded likewise a 1.5 billion FVA loss, and in the COVID financial crisis, we had again some, with the fact that major bank credit spreads spiked by a factor of 5 in some cases, we saw again a very, very important FVA losses. I'm mentioning American banks, but it's equally true for European banks. And the connection between XVA at the trade level and portfolio-wide XVAs is that the individual FTP of a trade, so the XVA correction for the price of an individual trade, is in fact defined as the trade portfolio incremental XVA of the trade, which means the XVA of a trade is in fact the difference between two portfolio-wide XVAs, the XVAs of the portfolio including that trade, and the XVAs of the portfolio excluding that trade. So the objectives of this course are, first of all, to derive sound principle-based XVA metrics applicable to both bilateral and centrally cleared transactions, and then to address the ensuing computational challenges. And the three main references are this positive XVA's paper, this paper with different co-authors. So Claudio Albanese is specialized in XVA and other front office analytics. Ron Skidson is a quant at ANZ Bank in Singapore. Boisa Saladin is a PhD student. Yannick Armonti is a former student and now a senior quant at BNP Paribas, specialized on CCPs. which means this paper is at, let's say, abstract and conceptual level, and it is then applied in these two companion papers to bilateral trade portfolios and to centrally cleared portfolios. So I will start by providing a bird's eye view on the XVA approach, which is developed in this course. And then this will be made concrete first in a static setup. It's amazing that most, not to say the totality of the ideas of the conceptual approach can be reflected in a very simple one-period model, which means I will spend a significant time in this one-period model. The only thing that you cannot do in this one-period model is, of course, squeezing in a one-period model the richness of your portfolio if you're a bank, which means at some point we need to make it dynamic, which will be the next section, but I think it's useful to separate understanding of all the ideas, and this can be done in a static setup from, let's say, implementation of all that in a dynamic and continuous time model, which will be achieved in the second step. So before coming to the technical and computational applications, we want to understand what deserves to be priced and what does not, which is not a trivial thing in this case, because there are a number of rather subtle double counting and overlap issues which have to be disentangled so that we are sure that we are not pricing 2 times the same things to the client, or pricing to the client something which does not deserve to be priced, which means we need a conceptual approach. A conceptual approach to pricing means it cannot be only pricing, it has to reflect a strategy in the background. I'm not saying hedging strategy in that case because the way we put it, it's XVA mainly pricing counterparty credit risk incompleteness, but our price will be the price of a certain collateralization, accounting, and dividend policy of the bank. Okay, so that's what I want to emphasize. So the logic, the underlying logic is that we want a pricing, but also collateralization and also accounting and also dividend release policy for a dealer bank in the spirit of the post-crisis regulation, meaning which is sustainable. And by this, we mean that this strategy should ensure to the bank shareholders a target hurdle rate H on their capital at risk, even in the limited case of a portfolio which would be held on a run-off basis, meaning without future deals. And the goal is to avoid what we saw in the global financial crisis, these Ponzi kind of schemes, where I'm showing here the volume, the notional, in fact.
Yo no entiendo nada, se está hablando en francés o en inglés. Yo estoy... Madre mía.
So please turn off the microphone.
Okay, so we see here the exponentially increasing accumulated notional of in black interest rate financial derivatives during the years 2000 to 2018, and we see this exponential increase at the turn of the 2007, 2000. I mean, before the global financial crisis. And one interpretation for this increase is that banks were led in a spiral where fault of, let's say, a profit release policy, banks were, let's say, distributing profits immediately. And then if you distribute immediately the profit on a swap, let's say on day one where the swap is issued, it means you have no more resources to remunerate your shareholder for the risk on this swap during the 30 years, let's say, that the swap is living. No other resource other than issuing new products, okay, constantly. So to avoid that, one needs to install a return earnings policy where profits are only gradually distributed to the shareholders so that they get a constant target hurdle rate H, let's say 10% on their capital at risk, dynamically throughout the whole life of the portfolio. So this is a goal, and there are a number of regulatory constraints that should be met in the first place by the strategy of the bank. The first constraint, of course, is that the market risk of the bank should be hedged as much as possible. So the Volcker rule, we assessed after the crisis that a dealer bank is not supposed to do proprietary trading. So even if the bank has a proprietary trading account by a CCP, the motivation for this account is that it should be used for doing hedging of bilateral trades that sit in the background, which means in the end, it should be mainly unhedgeable risk that remains, which means mainly counterparty credit risks that remain. It was recalled in the introduction by Santander that for most of your, let's say, small clients, there is certainly no liquid CDS market on those names, so you cannot hedge their defaults, really. Maybe you can partially hedge the edge of the, let's say, credit spread risk, but certainly not the default itself. And you can even less hedge your own default as a bank because you are not entitled to sell credit protection on yourself. So the net picture would be that you are left with uncompressible counterparty credit risk, and that's the topic of XVA analysis. Okay, so the second constraint is that because there is this uncompressible counterparty credit risk, this should be handled by reserve and capital. So regulation asks that banks should maintain a certain level of reserve capital to deal with their expected counterparty credit risk. I see some questions on the slides, so we decided that question would be taken in the end of the sessions. So this expected counterparty credit losses come along two lines, right? Credit valuation adjustment, which is meant to cope with the counterparty credit risk triggered by the default of the clients of the bank. So here we are talking about expected losses of the bank due to client defaults. And symmetrically to that, we have the funding valuation adjustment of the bank, which reflects the expected risky funding expertise of the bank, where the bank needs to borrow to address margin calls, let's say, and this is costly for the bank. Not only a risk-free cost, but also a risky cost because the bank itself is deemed risky, as reflected by the CDS curve of the bank. But that's all expected costs, right? So in case exceptional losses would occur, the bank needs to have capital at risk. And that's exactly why there should be this hurdle rate H, okay, as a remuneration to the shareholder of the bank for their capital at risk within the bank. And it should be obvious, but it's not the case, that an XVA approach, okay, should, result in reserve capital and capital at risk target numbers which are non-negative. By nature, reserve capital and capital at risk are non-negative. Okay. In addition to that, the regulator would not accept that capital numbers or capital target numbers at least decrease simply because the credit risk of the bank itself has worsened. I'm mentioning this, which should be obvious, but if you go in the literature, you have a number of papers which are promoting or advocating XVA metrics, which in some scenarios could decrease simply because credit risk of the bank itself has deteriorated. So still further requirements on a solution to what I call the sustainable pricing and dividend release policy problem are that a solution that we propose should be economically interpretable and logically consistent, and that's important so that it meets intellectual adhesion by market participants. Otherwise, the solution will not be kept by the market. And of course, it should be numerically feasible and robust at the level of realistic banking portfolio. That's for practicality. And on top of it, all other things being equal, the price of our strategy should be as small as possible. The reason being competitiveness. If you come up with too conservative XVA numbers, then it will not be acceptable because you will just lose deals. And here we need, of course, to be a bit more precise and to distinguish between portfolio-wide XVA numbers from trade incremental XVA number. I mean, it's not because your portfolio-wide numbers may be a bit conservative that your XVA numbers for the next trade will be larger than the one of your competitor. Okay, so that's this is how we approach the problem. Okay, we want to develop a pricing approach which underlies a certain collateralization, accounting, dividend release strategy that is sustainable in this sense. That's what we want to avoid. That's what regulators said should be avoided after the global financial crisis. But there are a number of constraints, regulatory constraints, like market risk of the bank should be hedged, which means it's mainly a story of residual counterparty credit risk. The bank should maintain reserve capital and also capital at risk. These reserve capital and capital at risk are, of course, positive numbers, and they should not decrease simply because the credit risk of the bank has worsened. And our pricing approach should be solidly grounded in economic and logical terms. It should be feasible, robust at the level of the portfolio of the bank, and it should not be unnecessarily conservative. So now, so this is the problem that we pose. And now I will present our solution setup. Okay, our solution to the problem is, as a starting point, a certain setup, including an organizational and accounting setup and separation that we advocate between three kinds of business units within the bank. So just taking a look at chat, but again, questions will be analyzed in the end. Okay, and this point out to this picture that I made available even now, that you can access by the website of the conference, which is this picture. I hope you can see it, complain otherwise, which is a picture of the balance sheet of a dealer bank. But you can almost take it as a picture of the bank, okay? Because what you see on the bottom, okay, in dashed, okay, is the part of the balance sheet related to the trading of the trading desk, let's say the originating trading desk, the business trading desk. I call them the clean training desks, and clean refers to the fact that these guys, the way things will be organized, do not have to care with counterparty credit risk, because some other desks of the bank are doing it on their behalf, so they can focus on their, primary business line, like an interest rate trader can focus on interest rate risk. He doesn't have to care about the fact that the client might be defaultable. That will be handled by people above his head, so CVA trader, treasury, etc. Okay, so that would be the floor 0. Okay, the ground floor of the bank. On top of it, the first floor will be occupied by the CVA traders and perhaps the treasury, so FVA traders. So these desks I call CA desk, because in my notation, the sum between CVA and FVA denoted by CA, where CA means contra assets, because these people, CVA trader and treasury, are dealing with, let's say, cash flows, which are an indirect effect of counterparty credit risk, which is modifying the contractually promised cash flows, and therefore I call these indirect cash flows contra asset cash flows that these people are handling, which means that these people are first of all valuing these cash flows, and they are charging to the client the corresponding value, and this value goes in a dedicated reserve capital account, which is this asset account of the bank, which you can see in this box here, which is a mix of CVA plus FVA. And then immediately, this value is an asset to the bank, but it's also an equally valued liability for the bank, because this money that sits here is devoted for CVA trader and treasury to be able to deal with client defaults and risky margin calls in the future, at least in expectation, but only in expectation, because these cash flows can only very partially be hedged, and that's why we have the third floor of the bank, the floor of the management, which also plays the role of a KVA desk. So risk desks are computing, let's say, a certain level of economic capital. And then then the management would distribute to the bank shareholders a remuneration on the risk, where the risk is is computed by this economic capital as a target level, but economic capital would be revised, let's say, every year. In our mathematical setup, it will be revised continuous time, but in reality, at least every year. So it is every year that bank shareholders should get 10% times their risk. So to achieve this gradual release of dividends to shareholders, the bank needs a dedicated account, and this is this risk margin account that you can see here, which will be sized by the theoretical KVA value, which is required so that the management can indeed do this gradual dividend release to the shareholders. And then this interesting feature of this risk margin account is that it plays, in a sense, two roles. It plays the role of a reserve for future dividend release to shareholders. But because dividend release to shareholders is not mandatory for the bank, a bank will not default immediately because this quarter no dividends have been released. Now we know firms which have the policy of never distributing any dividends. Okay, so this is still to the courtesy of the management of the bank to decide each term to distribute dividends and by which amount. Therefore, this risk margin account is also loss absorbing, right? The difference between CVA and FVA that you see below, so between the difference in nature between CVA and treasury and reserve capital account and risk margin account is that in front of this reserve capital account, you have these matching liabilities. Because, if you owe, if a client defaults and you have to pay a default loss, I mean, if you don't do it, you will default. Right? Whereas if you decide not to pay dividends, that's fine. So there is no matching KVA liability, if you want, in front of this risk margin account. Therefore, this risk margin account is also loss absorbing. And therefore, if economic capital, which is this red arrow, is, let us say, 100, but there is already, let's say, 60 sitting in this risk margin account, because the 60 is already loss absorbing, it's only the difference red minus 60 which needs to be asked to the shareholders so that they put it at risk. So there is a distinction between target economic capital, which is this red, and shareholder capital at risk, which is in fact only the positive difference, so the positive part, if you want, of red minus risk margin. And this is important because it means that at the time of distributing dividend to shareholders, this dividend should be a proportion to this, sub-box of capital at risk in totality. So, and on the very top of the bank, I put in dotted lines what I call contra liabilities, which are assets, but which are certainly not core equity tier 1 capital, because these things are valuing whatever money the liquidator of the bank, as a matter of fact, will get when the bank defaults, because the bank is then not reimbursing the third party which is funding its margin debt, or because the bank is maybe not paying some cash flow to its clients, and this is all money which enters the bank at the time the bank defaults, or even after, but this is too late for the bank shareholders to benefit from this value. And this value cannot be monetized before default of the bank, as we will see. So, which means this value is, in a sense, paper value. Okay, it does not contribute to core equity tier 1 capital. So it is not. This value here does not contribute to the. It's only accounting equity, if you want, but it's not core equity. So I'm back to the main slides. Okay, and I was saying that we are advocating this separation between different business units within the bank, and this separation will be part of our solution to the problems that we need to address. So we'll have these different desks, so the contra asset desk, the CA desk, the clean desk, and the management of the bank. And I think I already spent time explaining the mission, the mandates of the different desks. I want to be a bit more precise about what the CA desk is doing. So the CVA traders are, in a sense, guaranteeing the trader of the clean desks against client, but also bank defaults. And in practice, this will be achieved through a clean margin account of rehypothecable collateral between the CA desks and the clean desks. And this clean margin account will play two roles. It will serve as a guarantee in case client defaults, and it will also fund the trading of the clean desk at the risk-free rate, which means the clean traders, okay, when they need money for their trading, they ask money to the treasury, and they get it, and for them, they get it from the treasury at a risk-free cost, and it's only the treasury itself which will borrow maybe money from the outside of the bank at a risky spread, and the corresponding value will be then charged to the client by the treasury at an XVA value. This is what makes the life of the clean desk beautiful, so they don't have to bother about counterparty credit risk in their model. And this is important because, you know, the CVA traders, treasury, they have to deal with that, but they only do that. So they are specialized in that. Whereas if you go now to the originating clean desks, they have already a lot to do to bother with, I don't know, interest rates, inflation, etc. They have to be, it's important that they can focus on their, let's say, primary business risk. And as a matter of fact, if they should also account for counterparty credit risk, it would be impossible because counterparty credit risk can only be assessed at the portfolio level. Okay, and I already said that what the management is doing. I'm just adding here that in our setup, economic capital will be modeled as an expected shortfall at a level of 97.5%, which is 1 minus 1 over 40, of the losses of the bank over the next year, dynamically in time. And the 1 minus 1 over 40 means that you can interpret this economic capital as the safety cushion which is required so that the bank will successfully address a 40-yearly adverse year. So let's say every 40 years, there will be an exceptional loss of a magnitude that the bank will, on average, be able to face because the bank is constantly setting at risk this 1 minus 1 over 40 expected shortfall of its potential future losses over the next year. And again, because the risk margin is loss absorbing, but the regulator wants to see at least this target economic capital amount on the risk margin, on the capital as capital at risk. And with now minimality in view, as we said, capital at risk in our model would be defined by the maximum of the economic capital that the regulator wants to see, and of whatever amount of risk margin sits on the bank accounts anyway, and is already capital at risk. So I talked a lot about expected losses, which should be the target for CVA, FVA. I also mentioned an expected shortfall that should be the target for economic capital. But this means I was referring implicitly to a certain reference probability measure, which is denoted by Q star in my slides. And then the question, of course, is which probability measure Q star am I talking about? Am I referring to a risk neutral measure, or am I referring to a physical measure? Right? Whatever this means, because it's not totally obvious actually what a physical measure should mean in an XVA context where I have to account for cash flows between now and in sometimes 70 years from now. Talking about, I don't know, that big inflation trades. Okay, this can be as long as 70 years, right? So what does it mean? Physical measure at this scale, right? A risk measure is probably much more tangible, right? Because I can at least calibrate it to derivative prices, okay, which are forward-looking. Which means physical measure in this context is more about user views on the unhedgeable risk factor. And okay, the technical meaning of my measure Q star is in fact a blend of risk neutral and physical in the sense of user views, and a blend in the following sense, which is used in insurance, in fact, which means there is a financial sigma algebra, obviously, but because of what we said several times already, that in this context, there are some truly unhedgeable things like client default, etc. The full sigma algebra in our model will be strictly more than the financial sigma algebra, which means there is a physical measure which is defined in the totality of this Gothic letter A here, for algebra. Okay. There is also a risk neutral measure, which is only defined on the smaller financial sigma algebra. And then our Q star is a probability measure on the full sigma algebra, which can be shown to be uniquely defined, so that it coincides on the risk neutral pricing measure. It coincides, sorry, with the risk neutral pricing measure on the financial sigma algebra. And it coincides with the physical measure conditional on the financial sigma algebra. So it's not difficult to show that these two conditions determine a unique measure Q star, and this is the one what we have in mind when we say expectation of this or expected shortfall of that. And now, just to make the notation a bit lighter, we are using everywhere the risk-free asset as a numeraire, so we don't have to bother with risk-neutral discount factor. So R is 0 if you want, at least in the notation. Of course, when we do the numerics, when we show XVA number on interest rate portfolios, we are not saying that interest rate is 0. I mean, in the math, R is 0. And okay, as a last part of this bird's eye view, we have to be, it's time to be a bit more precise about the rules of the game, right? Because we have a conceptual approach, we want a conceptual approach which is solid, which is flexible, which you can adapt to bilateral trading, central trading. So what are the rules of the game? Let's be a bit more precise. So first of all, the portfolio that we'll be interested in will be supposed to be held on a run-off basis between inception time 0 and final maturity, which means we say in our model that the bank locks its portfolio at time 0 and lets it amortize in the future. Okay? And of course, it's a big assumption. And here you might even complain and saying it is not realistic. And of course, it's not. However, a very important point is that this assumption is not done for tractability or because we don't know the future deals that the bank will be able to conclude. This assumption is in fact perfectly legitimate, and we will see in a few hours that the proper way to address the XVAs of the next deal, because this is after all one major motivation for this computation, is to define them as XVA in the run-off sense of the portfolio, including the next deal, and XVA in the run-off sense of the portfolio excluding the next yield. So I'm insisting that this assumption is not done for practicality. It is, there will be a theorem wrapping up of approach, which I hope will convince you that at the end of the day, this will be a perfectly legitimate assumption to do. It's not done for simplicity or by default, so to say. Another thing is that all bank accounts will be assumed to be marked to model, and will even assume that they are continuously and immediately readjusted to their theoretical target levels, which means we'll assume that these, I call them the balance conditions, hold constantly. That is, this clean margin account between the CVA and treasury desks and the business desks, okay, will be constantly readjusted to reflect the mark-to-market of the portfolio, which means the counterparty risk-free value of the portfolio. This reserve capital account will be assumed to be constantly readjusted to the theoretical CVA plus FVA value. And the risk margin account will be assumed to be constantly readjusted to the theoretical KVA value, which means back to the balance sheet at time zero, where the portfolio is created. The client will have to provide MTM money, which will go there in this clean margin account between CA desks and clean desks. The client will have to provide CVA plus FVA value, which will feed this cash account here. The client will have to provide KVA, which will feed this RM account. And then, as time goes on, and let's say a client default and this value is eroded, but the theoretical value of these boxes also moves because precisely there has been a default, so the portfolio is modified. And therefore, there is a discrepancy that is introduced between effective reserve capital on the left and theoretical liability on the right. Then we assume through this mark-to-model assumption that the shareholders will actually immediately provide whatever money is required to restore the balance between left and right. Okay, and similarly here, if there is a gap between effective and theoretical value here, shareholders will be, dividend will be distributed so that this account is constantly readjusted to its theoretical value. Okay, which means instead of saying every quarter or every year we made some readjustments, we are saying in our mathematics that these balance conditions hold all the time. So I already said what happened at time zero. So at time zero, the clients are providing whatever money is required. At later times, it is on shareholders to readjust the accounts, at least unless the bank defaults. And then we need to say how contracts are settled in case of default. So here, the rule is that at the liquidation time, denoted by TC, of a netting set C between two counterparties, in the case where only one of the two counterparties is in default at TC, because of course it may happen that at the time of liquidating a contract, they are both in default, but in the first case where it's only one of the two that is in default, then if the debt of this counterparty in default toward the surviving counterparty does not exceed the margin posted by the counterparty to the survivor, that this debt is reimbursed in totality, is paid in totality. Otherwise, this debt is only reimbursed at the level of the posted margin plus the recovery fraction of the residual debt beyond the margin. If now both parties are in default, then what happens is, I will see later, it cannot be that each of them is indebted to the other beyond the posted margin. So it's only one of the two, at most, that can be indebted to the one beyond its posted margin. And then the rule is that this counterparty will transfer to the other the property of its posted margin plus its recovery rate times any residual debt beyond the margin. If nobody is indebted to the other beyond its posted margin, then the debt between the two is fully settled using the margin. And by debt here, I mean counterparty risk-free value and I put net, but I should have said plus all the contractual cash flows that have been unpaid, perhaps, during the liquidation period. And I need to add that the entity within the bank, which is in charge of the liquidation cash flows, is the CVA desk. Okay, so now we, okay, the last thing is that if the bank defaults, then any residual amount on this account, okay, goes to the liquidator. It's lost for shareholder. And likewise, here, if the bank defaults, any residual reserve capital amount, which means any residual CVA value within the bank, is lost for shareholders and goes to liquidator. And it's important, if we were not assuming this in our model, let's say that the rule would be that in case of bank default, I don't know, let's say a reserve capital amount flows back to shareholders, then our XVA model would be arbitrable in a sense. Because that would mean that if I was the shareholder of the bank, what I would do, the game I would play would be, okay, let me be the shareholder of this bank. Let me wait for the bank to find a client. And the first client that comes and put money in this account, I would immediately trigger the default of the bank. That's my power as a shareholder. And I would capture this value without risk. Okay. So that's why we have to make this rule. I think I lost my PDF. Let's open it again. Okay. Sorry, I cannot see my PDF. How comes? Okay, maybe I will close this completely. Close Adobe. And open it again. Okay. And hopefully you can still see it. Otherwise, let me know. So this is where I was. Okay. So if you cannot hear or see, please complain. So now we really set the stage, okay? And we'll be able to derive our XVA metrics from these first principles in any situation, whether it is a very simple static one-period model, or it is a continuous time model, and whether it is bilateral trades or maybe trades with CCP, this very same principle will be used in all times. Okay, but the lesson of all that, if we should summarize by one sentence, is which is the main picture, the one I was constantly showing this morning, is that the balance sheet invites itself into the pricing. Okay. Before becoming, let's say, concrete, I'm stating my hedging assumptions here, but this is just for, let's say, for simplicity in the slide. Okay, they are not strong assumptions. They are not hard. It's not binding assumptions. I'm just assuming. I'm just putting myself in the limit where the market risk of the bank, where the clean desks are perfectly hedging themselves, right? So, which means the P&L of the clean desk is zero at the end of the day. And conversely, the XVA traders, so the CVA traders and the treasury, are not hedging at all, right? In reality, they do to some extent, and it is included in the papers, but in the slides, I'm not doing it, just to have a bit less heavy equations. Now, of course, the pending question is, I would say, what are the cash flows, right? So this is again by picture, simpler version. This is really the building of the bank. So the clean desks sit at the bottom, but on top of their head, we have the CVA desk, and on top of the CVA desk, we have the treasury desks. And then of a different nature, we have the management, which is taking care of dividends, which means clean desks are by the contracts of all the derivatives. They are supposed to get some cash flows, and denoting them by this capital letter P, because essentially we see that the cash flows to the clean desks are essentially the contractually promised cash flows. Not exactly that, because imagine a client default, then contracts could be just ended, and therefore the corresponding P ceases to be paid by the clean desk, but the clean desk will have a compensation corresponding to the remaining value of the cash flows. So essentially, again, this P, like promised, corresponds to the contractually promised cash flows. We need to clarify the cash flows which are perceived by the CVA desks, because these cash flows tend to be negative, so costs are denoted by the negative of a letter C for credit, if you want, anticipating that this C will be mainly the losses of the bank due to default clients, but it will also incorporate the benefits of the bank at its own default. F will be of the same nature of C, but will embed whatever is related to the risky funding business of the bank, and the management is distributing dividends, which are denoted by a letter D. But again, our next task is to come up with concrete expressions for these random variables in a static setup or processes in a dynamic setup. And again, just to address difficulties one after the other, once the principles have been stated in this first chapter, I will apply this principle in a one-period model in the next chapter, so that we see what happens, and we come up with essentially explicit formulas for every participant in the game, so all the VS, etc. Okay, so I'm assuming that at time 0, the bank enters a derivative position with a client, so single client, a single contract. Okay, and it's only a 1 year 0-1 setup. Okay, the random variable P denotes the cash flow written in the contract promised by the client to the bank. Mathematically, you can think of it as a Gaussian random variable, if you want. doesn't have to be centered, it can be anything. Okay. The thing that the bank and the client are both default prone, and we assume zero recoveries just to spare a few notations. So, of course, in the following chapter, the philosophy will be completely opposite. So I will restore, all the complexity of the real setup of a bank. But here I really want to focus on the principles. I note by J and J1 the survival indicators of the bank at time 1. What it means that J is a random variable. Bank still alive at time 1 means J is 0. Sorry, the opposite. Bank in default at time 1 means survival indicator is 0. And the proba that J is 0 is denoted by gamma, assumed strictly between 0 and 1. Now J1 is an analogous random variable to keep track of survival or default of the client at time 1. I assume that unsecured borrowing by the bank is fairly priced by the market as gamma times the amount borrowed by the bank for funding its trading. And I'm assuming this, the bank is paying gamma times borrowed amount. And on the side of the edge, I'm assuming that there is a fully collateralized back-to-back market edge that has been set up by the bank in the form of a deal with a third party with no entrance cost and a payoff to the bank, MTM minus P at time 1, so value minus cash flow if you want, irrespective of the default status of the bank and the third party at time 1, which means this is fully collateralized. This MTM minus P will occur whatever the default status of the bank and its edge counterparty. Okay, so it's a kind of a magic deal, okay, which guarantees this MTM minus P. If we wanted to dig a little bit how this deal happens, think you have a CCP, which is a third party, okay, which to the effect that indeed on the edge side, this will happen, whatever the default status of everybody in the system, time 1. The thing is, in reality, this edge has itself an XVA cost, but we will address that, later, much later, if time allows. Okay? But at that point, let's say this fully collateralized back-to-back edge can be set up at no XVA cost for the bank. And okay, now we also want to be precise about funding. I will open the picture again. This is the picture. What happens is that because the bank has at its disposal all this cash sitting here, and also all this capital at risk in red, if the business of the people at the lower levels requires that the bank should borrow some money on the markets, okay, before going to the market to actually borrow money at its own risky spread, which is costly, obviously the bank would use this money which is sitting there and doing nothing, okay? And the bank would also use this money, which is sitting there and waiting that some loss requires it, okay? So the point I am making here is that for simplicity in a first stage, which means this assumption will be relaxed later, I will ignore the fact that the bank can use its capital at risk for funding purposes. I will only consider in this respect the reserve capital RC, which is sized, I call it by CVA plus AVA, which I denote by CA. Right? So I'm starting by this simplifying assumption, and then I will restore the possibility for the bank of borrowing less and therefore paying less in funding costs by using its capital at risk as, in fact, a risk-free source of variation margin. And I will see also only later introduce the collateral between the bank and its clients. Okay, so that's why we are not seeing any initial margin or even any variation margin in the coming slides. So then, in this minimalistic setup, but which retains all the economic flavor of the problem, as we will see, the lemma is the following. The lemma is stating the cash flows, huh? And I'm calling it the lemma because these cash flows that you see here, and which again correspond to the counterparty credit risk related cash flows and to the risky funding related cash flows. It's not a definition, it's a lemma because these cash flows will be obtained by application to this concrete setup that we just introduced of the principles of chapter 1. It's important because if you are too quick, if you say, okay, this makes sense, because after all, it makes sense. You see that credit cash flows come in two parts. There is the fact that if the client defaults, so J1 is 0, and J1 is 1, the bank is losing positive part of whatever the client is owing to the bank, and you have a symmetrical here if the bank defaults, so you might be tempted to say, okay, by definition, this is the cash flow. Okay, but when the setup becomes more complex, then you get lost and you make mistakes. So we really want to obtain cash flows by application of general principles. And here the way I reformulated the result is by multiplying this guy by j, and then j times 1 minus j is 0. So we just have j times this thing, plus, so I did say c equals, of course, jc plus 1 minus jc. This is jc, and this is actually 1 minus jc. And the reason why is because it's interesting to split all cash flows between whatever cash flows are on the event where the bank is still alive at time 1, from cash flows on the event where the bank is no longer alive at time 1. And on the risky funding side, again, in this very, very simple setup, you might say, of course, this makes perfect sense. These are the funding cash flows. This is the fact that, to fund our trading, that setup, the bank needs to put, let's say to be simple, the bank is buying the deal from the client at a price which is MTM minus CA, as a matter of fact, minus CA minus KVA. But I said here, for simplicity in the first stage, I am ignoring this minus KVA, which means that F is actually a bit less than what I put here, but this is temporary assumption. So ignoring the minus KVA, the bank needs to borrow its own funding spread times the positive part of this difference. Because if this difference is negative, the bank is in the position to just invest, which means lend at a risk-free rate, the MTM minus C. Yes, and then what happens is that if the bank defaults, then the bank would not reimburse its funding debt, which is tantamount to a funding benefit of the bank by this amount, which is the size of the funding debt, in the case the bank would default. And again, I reformulated this in two parts, okay? J times itself plus 1 minus J times itself, which is this, to distinguish whatever of these cash flows falls in the accounts of the bank, or is paid, needs to be paid by the bank on the event that the bank survives, whereas this cash flows will in fact only impact the, let's say, the liquidator of the bank ultimately. Okay, so you might say this is obvious, but we want to practice and to get these results by application of clear-cut principles, which will be the proof in the next class. In fact, it's not so obvious, because if you go now to the XVA literature, you will find a whole, panoply of proposals regarding what these C and F are, including proposals where you would see no positive part here, or where you would see no minus here. So at the end of after all, it's not that obvious. We need to go to the proof. Okay, so let's go to the proof. So we are saying the trading desk of the bank pay MTN minus CA for the deal, whereas on the edge and as a portfolio settlement, what do they get? So we said on the edge side, they get this MT minus P, whatever happens, whatever default events may happen, okay? Okay. Sorry. Now, on the portfolio settlement side, there are 4 cases, okay? The client may default, and the bank may survive, okay? Then we have to go by this rule here, okay? That's the case where client default, bank survives. In that case, there is no margin, etc. Okay, so if you go to these 2 points, what they are telling you is that it will be minus negative part of P cash flow from the client to the bank, which means that if the bank is owing something to the client, the bank will pay. If the client is owing something to the bank, it will not pay. Okay, this is the exact symmetrical case if the client survives the bank defaults. And then when they both default, there will be no cash flow, no portfolio settlement cash flow at all. If they both survive, things will happen as promised. So P will be paid from the client to the bank. Okay, and then I'm just doing algebra here. And I get MTM plus, okay, I have these 2 cases. And then this quantity here, which the bank receives, means the opposite quantity that the bank pays, just switching signs, but the bank is also paying this. So negative of that guy, including a minus MTM, plus MTM minus EA, this is the result. So the bank is paying all that, okay? But minus EA is the valuation component. The cash flow itself is this, and this is what I put here. Okay. Now, on the funding side of the strategy, the bank needs to pay, to borrow this positive part. The bank is paying this amount, but if the bank defaults, the borrowing debt will not be reimbursed. So the bank would keep this. So this is means the bank is making a profit by this amount. Okay, and again, it's this is proof. This is lemma. This is not statement. And again, when SAP is very easy, we might say it's obvious. Well, it's almost obvious. Not so obvious because again, some people would argue that F should come without a plus here. or some people would forget to retrieve the minus here. So this is just rewriting, this totality of cash flows, and just switching signs everywhere to provide a slightly different angle on what the bank is getting. Okay, so the bank is getting, and I'm also putting J on the first line versus 1 minus J cash flows in the next line. Okay, just to emphasize that everything here, which is received by the bank in case the bank defaults, is I mean, these people here, okay. When I'm saying received by the bank in case the bank defaults, it actually means received by the liquidator of the bank. Okay, because at the time of the bank defaults, as we put in our rules of the game, every posterior cash flows, I mean from time tau onward, go to the liquidator. So, which means if I should define the loss and profits of the bank shareholders, it's only the first line which affects the shareholders. The next two lines affect the liquidator. So let's keep in mind that the P&L, actually, the loss and profit of the bank is in fact only this equation 2. J times the total L. I'm switching this, which is the connection with a more structural view. Now that we have clarified the cash flows, let's go to their valuation. Okay. And here there is a very convenient mathematical tool, which is an auxiliary measure, which is a bank survival measure Q star associated, sorry, the bank survival measure Q associated to our hybrid, risk neutral / physical measure Q star. So the definition of this measure Q is that the corresponding expectation E is such that for any random variable Y, E of Y is expectation under the original Q star of JY, J means survival of the bank is J is 1, divided by the proba of default of the bank. In other terms, Q is the measure Q star conditional on bank survival event. And that's what it means. Okay. And passing to this survival measure Q will simplify some of the formulas. Okay. Okay. Here the small lemma is that saying that a number Y would be Q star expectation of J cash flow Y plus 1 minus J same number Y is the same thing as saying Y, number Y is expectation under Q measure, under the change measure of cash flow calligraphic Y. And I mean, the lemma is obvious, and Y is just number, so you pull it under the expectation here, and then you use 3, and saying that E star of J something is 0 is equivalent to saying that E of this something without the J is 0. And because Y is a number, you pull it out again from the expectation. So this is important because what will happen is that all our XVA variation equations will be of this kind. So they will look like fixed point equations for the number Y. But viewed from the auxiliary measure, you realize that that's how this defines a well-posed number Y. So now, how will clean desks, CVA desk, FVA desk value their cash flows? Okay. So the view is that they should be aligned to the interest of the bank, which means to the interest of the shareholder. So their mandate is to value the respective cash flows at a level MTM for the clean desks, CVA, FVA for the treasury and the CVA desks, so that the shareholder P&L originating from their respective business unit is zero on average under the Q-star, under the reference quality measure. Which means we have equations for MTM, CVA, FVA, which are exactly of this kind, if you want, where a number y should value a cash flow calligraphic y. That's exactly what happens in each of the three cases. So they look like equations, but switching to this survival measure reveals that these equations are well posed, that the CVA is simply the bank survival measure expectation of this random variable here, which is client default times positive part of P, that the FVA is simply bank survival probability of this thing here, but because in the case of the bank, the cash flow F is deterministic on the event that J is survival of the bank, this ends up being just this number, completely explicit. And then it's interesting because this bank trading P&L, which was that in principle, because that's a one period setup, then this second part vanishes, and the trading loss of the bank is a pure credit loss CVA P&L. This simplification where this difference is zero and the P&L of the bank reduces to that is the only feature which is specific to the one period setup. Okay. In a dynamic setup, this guy would be random and would contribute to the risk of the shareholders. Apart from that, we are not losing anything in terms of ideas doing things in this very simple setup, as we will see. So I was here, and here we need to make a remark. We said clean desks also have to be aligned to the bank shareholders. So they are led to define mark to market by this, at the end of the day, bank survival expectation of the promised cash flow P. But at the same time, the clean desks have to hedge themselves. Okay, so which means we also need to insist that MTM should be Q-star expectation, not simply survival expectation of P. So we have this kind of, let's say, consistency assumption on the deals that a star of P and E of P should coincide. Okay, and if we try to understand what this means, it implies that E star of J times E star of P is one, so E star of G is bank survival proba, so 1 minus gamma under Q star. E star of P by this consistency assumption that we make is just E of P. But here we then get 1 minus gamma E of P. And if I go back to this thing, 1 minus gamma E of P is E star of JP. Okay, so this equation 6 that we just proved reveals that our consistency assumption means that J and P, the default of the book itself, and promised cash flows have to be maybe not independent, but something in this direction. So, for instance, P that would be equal to J would violate 6. So it means this consistency assumption forbids that the bank could trade its own credit, which, by the way, is perfectly reasonable because we know it's forbidden. Okay. But at the same time, in a static setup, this assumption is quite strong, maybe. So that's also something which would be considerably smoothed out in a dynamic setup. The analogous assumption that will be made in the dynamic setup will be very, very much milder than that. A last thing is that FVA has to be gamma this difference. This looks like a formula, but it's still an equation because CA, if you remember, is a sum between CVA plus FVA itself. So what we have is this. And that's okay, because it's a semi-linear algebraic equation where gamma is positive. So this is a solution. When we will be in continuous time, of course, things will be technically considerably much more complex. Okay, the step by which we get rid of this implicitness will be enlargement of filtration, in fact, reduction of filtration, and then the step by which we'll get rid of this kind of implicitness will be by solving backwards stochastic differential equations. I mean, in a one parent model, we have the flavor of all that. The only difference is that you solve it explicitly. And I see Elisa popping in, so I guess I should stop quickly. So I think you are mute. Okay. You are muted.
I think it's a good moment, or?
It's okay. It's not bad.
So I think we can see the questions in the chat.
Okay.
So we have one question from